Hi there, this is Brian Calley coming at you from SBAM headquarters in downtown Lansing. I am the CEO of the Small Business Association of Michigan. Thanks for joining us today.
Hi, everyone. Sarah Miller, Vice President of Marketing and Strategic Communications. Thanks for joining us. I want to say a welcome to all of our new members, but we're highlighting our new member, Michigan Section American Waterworks Association, and their Executive Director, Bonifer Ballard. So welcome to them and to all of our members who've joined us in the past week. So Brian, we might have a special guest. He might be coming in hot. We'll see if that works out. But while we wait, let's talk about crime. The National FBI crime statistics came out. And what do those statistics tell us?
Yeah, I look at a lot of information and data in terms of trying to figure out what's happening with the economy and in terms of recession, how deep a recession, that sort of thing, and there are a lot of factors and a lot of clues you can pull from other different areas too, and really interesting statistics, some good and bad news coming out of the national crime statistics. The first thing I want to do, I'm just going to share. I'm going to share my screen and go to a slide here that shows that the murder rate in the U.S. overall is down this year. Now, as you can see from this graph, it's not down a lot, but it actually did go down since 2020 to 2019. Really, it had been rising, and so that's what I would classify as kind of the good news, if you will, that at least it stopped going up. It stopped going up and now is on the decline. However, property crimes are on the rise, and that's true nationwide. It's actually true here in Michigan too. So if you're to look at the Michigan specific, and we'll start though with Detroit, violent crimes in Detroit dropped 16.5%. So this would include murder, of course, but also like assault crimes as well, down 16.5%. However, property crimes, things like theft, rose 22%. And it's not unusual to see during times of economic uncertainty and times of economic strife and difficulty that you see property crimes start to rise. And that is happening here in Michigan, that is happening nationwide. Now, why would that be? Well, part of it, with inflation and things are more expensive, and so maybe on the margins, more people might turn to theft. But there's actually a more subtle reason too, that the black market, that the purchase of stolen goods, that there's kind of a higher demand as people look for alternatives to higher prices, that comes up. So that's those are some reasons why you might look at, so why crime statistics, what does that have to do with economic statistics? Well, the property style crimes are an indication of some of the underlying issues that are happening out there in the economy. So good news on the violent crime, bad news on the property crimes, and but also would suggest that maybe in terms of the economic condition of the country might be kind of a leading indicator, if you will, that there's trouble and perhaps some difficulty coming up. Now we had invited Sarah, as you'd mentioned, a guest to come on today to talk about some new legislation that is working its way through the process that we at SBAM are supporting. And you might recall in the previous legislative session last year, we had supported a proposal that allowed pass-through entities like LLCs or S corporations to pay their taxes at the business entity level, rather than having that just essentially flow through. And the reason for this is that it allows a more robust or complete deduction on your federal tax return in a roundabout way. So what happens here is that by paying your business taxes at the entity level instead of on your personal income tax, then you can deduct all of it at the federal level. But It passed very quickly at the end of the session, and there was some cleanup that needed to happen, and so I thought it would be a good excuse to invite our friend Jamie Lopiccolo back onto the briefing. You might recall, Jamie, it's been a little while since you've been on the briefing, so thanks for being available on fairly short notice to come in and talk about the legislation working its way through. And as you can tell from my struggling to describe this, that it's sometimes better to have a real pro on for this sort of thing. So thanks for being on, and maybe
Sure.
give us the scoop on this entity, this pass-through tax that could be a benefit for some small business owners.
Sure. Thanks for having me on again, Brian. It's been a while. Good to see both you and Sarah. Sorry I was running late getting in here. Kind of got into a project that was had my head down for most of it, so I apologize for my tardiness. Yeah, you hit it pretty well. The Michigan flow-through entity tax came in right at the 11th hour last year, and ultimately allows business owners to work around the state and local deduction, because it allows the deduction to happen at the corporate level, or the flow-through entity level, which then goes to their adjusted gross income, as opposed to an itemized deduction that's right now limited to $10,000. So, this was a welcome change for a lot of businesses. There's, in my opinion, there's still some things that you have to determine if it makes sense. But a couple of things that they had done in rushing this through, and the MICPA had testified last week regarding some of the new bill going through in support of, just as SBAM is, and they're really based upon election dates and the way that the credits work. If those that remember, this is an election that you make to do, and you have a 3-year election. Once you decide that you're going to be part of the flow-through entity, you make an election to do this process for 3 years. And the problem was they wanted the election before you knew what your taxable income was. So, like any business owners, they want to make decisions based upon facts and circumstances and informed information. And here we're relying on a crystal ball. And, my crystal ball has been in the shop now for probably 30 years, and I still don't see it's going to be work. So I can't advise, my clients what to do. We think that we're going to base on last year or whatever. And I really do believe that this credit is not for everybody. I think based on the compliance requirements and some of the other things, it just may not be there for some people. And so business owners were asking for, hey, can we do this election after our year end to see if it makes sense? And we know that we have to go forward 3 years. And so that's what they're testifying about is instead of making the March 15th deadline for the current year coming up, it's can we make it as a retroactive, which I think is a good, and as the MICPA had testified, I think there's 25 states that have these things, and the majority of them are allowing for this look back period as opposed to a look back forward. So I think that was I think that's a good call for and it sounds like the legislature is on board with this. I think they're just getting their ducks in a row to do this. And then the second one that we were looking at was the way that the carry forwards are occurring, or way the payments are. Right now, I believe that the law states that if you make the payment after December 31st or after December 31st of the year that the credit applies to, that payment really doesn't get credit to the individual taxpayer till the following year. So let's take, for example, we're in 2022, we make a payment by December 31st, 2022, that shareholder will get credit for that payment for the 2022 tax year. However, if you make a payment with the tax return, which is due in March, the Treasury was originally saying that, which would have been in 2023, that payment can't be credited to the shareholder till 2023. Kind of match, and we're kind of like going, wait, time out, that doesn't work. Because we're filing based upon income in 2022, but you're saying we can't get the credit for the payment till 23. So there's we're trying to get everything to align better. And again, I think that's consistent with a lot of other states that have this same type of tax. And so it's very consistent with the way that they want to see the rules as well. And like I said, I believe my last I had heard that Treasury is pretty much on board with this, but I think they're just going through the process of trying to get it changed through the legislative process.
Yeah, and it does seem like it has pretty good momentum, and that was the part. It was kind of it was kind of frustrating on the one hand to have something that could be a benefit to many businesses, But having to make this decision, are you going to file? Because it's an option, right? Not everybody has to
Right.
file. That was important to SBM because we knew that some of our businesses, if they're not at a point where they're itemizing deductions, then filing another tax return was going to be more of an expense and more of a hassle and more of a risk. So it's not going to make sense. We wanted it to be optional, but Treasury said, hey, you need to be in or out for 3 years, and then you're doing it before you even know what your first year
Right.
income is going to be. So this could be, I think there are many, many businesses that are going to benefit from this, but there are many that it's going to be better for them just to stay the course and do it how they've
Yeah.
always done it.
Yeah, and I Brian, I don't see where the only place that it hurts businesses is just the compliance cost. I think that's the biggest thing is from a tax point of view, it's going to be ultimately, it would be probably beneficial to most businesses regardless. The issue is what is the compliance cost to do this relative to, like you said, filing another tax return, the cost of that, a cost of keeping track of that and adjusting your, so there's compliance pieces. Now, as a CPA and as a tax preparer, it's a win for me, right? But it's not what I want to do for my clients. So I think as I had talked to most CPA firms, we all kind of established a certain level of income that we felt was right. And somewhere, and I want to say anywhere from 75 to maybe $150,000 of net income was kind of where people started the process with their clients, and then would go up from there, because if you factor in the cost of the tax and everything, it didn't seem to make sense at anything below that.
Well, we will continue to advocate and to support this legislation as it goes through, and hopefully as everybody is getting ready to file next year, you'll have this new tool in the toolbox, and keep a lookout. And by the way, this for our members, this is not the sort of thing where you have to figure out for yourself, right? This is the sort of thing that you would have your whoever prepares your taxes for you to talk to them about whether or not it makes sense. Do you make enough income to pay for the new return, and then what you'll save? Because I agree, everybody, just the way it's constructed, you can't lose on the tax front. It's just a matter of whether or not it's worth the extra hassle of another tax return and the compliance that goes along with getting it ready.
That's exactly it. That's exactly it, Brian.
Very good. Well, thank you very much, Jamie, for coming on. Great to see you, and we'll have to think of another excuse real soon to
would love to. Miss kind of being on with you guys. So yeah, anytime, feel free to give me a call. Let me know.
All right, we'll certainly do that. Thank you, Jamie.
You're quite welcome, guys. You have a great day.
You too. All right, Brian, let's talk a little bit about a new report that came out from the National Bureau of Economic Research that shows that people who have had COVID are 7% less likely to be employed 1 year later.
Yeah, this was actually kind of a surprise, as we look at like where all I've heard this a lot from members, from people that are trying to fill their positions, like where have all the people gone? And some of it is the demographics are working against us. We've talked about younger workers exiting the workforce, especially those with children, especially women, but also those over age 55 more likely to not be as well represented as they were in the past in the workforce. But also this new study showed that nationwide about 500,000 people out of the workforce that is believed to be somehow connected with COVID. So this idea that far after, and we don't know for sure. So I guess to put it this way is like, if you've had COVID, you're less likely to be a year later, less likely to be in the workforce. And that might be because, I've heard of this long COVID, somebody has longer term health issues that are associated with it. But it could be just, reorienting your life, or somebody had a harder time with COVID and therefore just decided you didn't want to. I don't know that the report doesn't really get into the why behind it, just that it is the case that there's a pretty substantial decline in the likelihood that a person is in the workforce a year later. So this just another one of these little kind of puzzle pieces as we ask the question of where have all the people gone and in terms of labor force participation. And it really does feed into this broader question, or kind of the broader conclusion, I should say, actually, that we've come to, which is that while there are lots of issues, there's recession risk. It's just a matter of depth and length. Really, I think every day it becomes that more and more the case. The idea that the supply chains are struggling and inflation. Those are all I think relatively shorter term issues and struggles to deal with. Over the long term, it's really about people, having enough people, and creating the type of environment success requires that we have people as consumers and as workers. And this is one of the pieces for that we're as we try to figure out where the people have gone.
All right, with that, I think it's time for today's segment of Data Monday.
Yeah, Data Monday. So the first slide was that I had highlighted earlier when we were talking about the crime statistics. Now, it's kind of an eclectic group of slides today, but some pretty interesting stuff. So starting with the interest rates, not a surprise that interest rates now up over 6%. We have not seen that since back in 2008. Now, this is one of the I'm going to show you a lot of things that just show that we're at a time that is where things are starting to look more similarly to the last time we had real economic struggles. And so 30-year interest rates being up over 6%, and more promises for increases in the future. And then this is for those refinancing activity is way down, but of those refinancing, what percentage are seeing higher interest rates? In other words, they are at a point where they have to refinance. Maybe it's debt consolidation, but they're refinancing into higher interest rates, and it's pretty much everybody at this point. So the only exceptions to that rule are people maybe that have very recently took out loans and needed to refinance them quickly for some reason. So this is then as we move forward here. This is the lumber futures, and look at how they've come down. So as you see, remember a few weeks ago, I talked about how the Federal Reserve, by increasing interest rates, it decreases the demand for new housing. And I thought this was a pretty good indication of the fact that it is having an impact. That is, as you see as interest rates started to ratchet up, you see the lumber futures are going down, and so it's just, it's monetary policy. There's some predictable outcomes, and this is just one of the stages that show that it's happening. It's one of the things where I know it's going to be a painful process. However, there's a lot of reason, I think, to believe that 6 months from now, the inflation scenario is going to look a lot different. I would say of all of them, this is probably the most worrisome to me, and that is that the New York Fed, they do a probability of recession. There's a lot of factors that go into this, but as you see this probability rising in the past, how well have they done? Here's the probability, and see everywhere you see a red shading there, that was a time of recession. And so this, while it's not perfect, like in these cases back here in the 90s, they were up and down without going into a real recession. But in most cases, when this probability starts to go up and gets up above a third, you see that it is there ends up being a recession. So that probability has really, it's like a hockey stick rise coming from the New York Fed. And then also Charles Schwab has their LEI index, and this is another one where shaded in gray, that's where historically there have been recessions. And as you can see, when the LEI index for Charles Schwab gets up, look at these other places where it's gotten up that high, you'll see in the shading that those are times when there were recessions. Now, I heard a very prominent economist that came here to Michigan, gave a very resounding presentation, and just was very forceful in the idea that we are not in a recession right now, but really presented a lot of evidence. While there was peculiar reasons, there were kind of unusual reasons why a lot of numbers are heading in the wrong direction. It doesn't change the fact that many numbers are headed in the wrong direction, even if there are different reasons for it now. And so but it's not all bad news. I wanted to share this one with you because, there are a couple of things that happen. Like, first of all, federal spending is returning to more normal levels, and this is proof of that. So if you look at the federal budget deficit as a percentage of nominal GDP. So I know there's some argument. People say, yeah, but the debt is higher, the deficit is higher than it was a few years ago. But I think it does make sense to look at the context of overall GDP. And if you look at that, we're back to the same, back to kind of similar to pre-pandemic times in terms of federal deficit spending. This is another reason why I think that the inflation is starting to, we're starting to create scenario or kind of an outlook here, creating conditions where inflation will come back under control because federal deficit spending is kind of normalizing. And you might recall that we took some positions against the last couple of federal spending bills, not because there was any particular line items that we did have concern on some line items in there, but it wasn't about the line items as much as it was about returning to a normal deficit spending scenario so that we can create conditions for inflation to come back under control. And so I think that that we're getting closer to that. Now, keep in mind, as inflation goes higher, okay, that's part of the reason why GDP is maybe not taking the same type of hit that it otherwise would have. Here's another thing that gives me a little bit of confidence. So we started out with some things that I'm concerned about. I'm going to finish this presentation with 3 things that give me confidence. First being this slide here that shows that the federal deficit as a percent of our GDP is kind of normalizing or returning to more normal levels. And then this one is showing the strength of the dollar. Now, I always have mixed feelings about the strong dollar. I've heard politicians say, brag, we've got a strong dollar. That means that US goods are more expensive overseas. But what this also means, and you see, this is, our dollar as strength compared to other currencies is reaching levels that, as you look all the way back to the 1970s, you've seen an increase here that's unprecedented. And what's happening here is that even though we have troubles here, that investors around the world have more confidence in the strength and stability and the ability to get inflation under control in the US as compared to practically every other option around the globe. And so there's more demand for dollars. People around the globe want to keep their stored currency, their stored value in the form of dollars. So while here we're looking at saying, whoa, 8% inflation, the risks of inflation, more persistent inflation, long-term inflation, and higher inflation in other places is greater than in the US. And so now maybe everybody could be wrong around the globe, but to me, when I look at federal spending normalizing, when I look at the monetary policy, the bond purchasing, and the Federal Reserve balance sheet coming back to normal, and the rising interest rates, all give me a pretty good picture that inflation will eventually come under control and normalize. And I think the strength of the dollar is showing that many people around the globe believe that as well. And looking at corporate bankruptcies, those actually have declined. Those have continued to decline since the period right after the pandemic. So while on the one hand, Sarah, I think that there are very, very clear indications here that our probability of a real recession and or that we're probably already in one is high and getting higher all the time. There's also good reason to think that steps are being taken to normalize our monetary policies and get things kind of back to a place where inflation can come under control. And really that, I think once that happens, really it is just workforce issues that are our main concerns for the future. So again, crosswinds, mixed bags, some real risks, especially in the short term, but long term, some reasons to think it's going to be okay.
Well, that's encouraging, that's for sure. That's all we have for you today, but before we say goodbye, we do have 2 webinars coming up. One is this Wednesday at 1:30 called The Power of Connection. And then next week, we're also going to have one on cybersecurity. So 2 great topics. I encourage you to visit sbam.org/events to learn more about those and register. And until then, we will see you on Thursday. Have a great week.
Hey, thanks everybody. See you on Thursday.